I've actually been meaning to ask you about volatility and volatility
Yeah.
managers specifically this year because, let's talk about the narrative. The narrative has been we had a big vol event in
Yeah.
March 2020. Everybody wanted tail. Just like after '08, everybody wanted Nassim Taleb's Black Swan Protection Protocol, right? And, in their minds, individuals thought bear market plus tail equals solving all my problems. And it hasn't been that way this year. I mean, obviously, why the Cockroach portfolio also included trend. I think you came to terms with that. That's needed specifically for these type of markets. But why isn't volatility done well in what may seem to most an ideal time for them? Long vol.
No, that's a
Or
great
any ball.
question.
Maybe
That's a
you can
question. Yeah.
maybe you can tell me about all the balls.
Yeah, no, I'll talk about like different strategies and everything and how the outlook has been so far this year. But like, I also want to address what kind of Mike said earlier that I thought was great when he was like, and I appreciate you, like, let's talk about what you guys do and Cockroach and everything. But like, it revolves around everything we're saying is like, you either like people buy from people, right? And all the nonsense I'm speaking on here, it either jives with you or not. So like, then you'll find out like what I do for a living. But otherwise, like, if you don't like, the cut of my jib or the way I represent myself, like people buy from people. So like if you understand the craziness of my brain, then you might understand the craziness of our portfolio construction. And so that's why it's like, there's a first principle idea to that. But so the idea with volatility this year, and people are like, why isn't volatility paid off when we're in such a drawdown in the S&P? And the way I've always thought about it, and I know we've all talked about this a lot, is like, whether there's uncorrelated return streams for managed futures or futures, like Adam's saying 13 uncorrelated streams, or like when Ray Dalio was talking about, you want to look for like 16 different uncorrelated return streams. At the end of the day, there's really just three correlations, right? It's either correlated, uncorrelated, or negatively correlated. And that's the whole point. It's like everything's correlated with equity beta, your equity, your bonds, your VC, your PE, and a liquidity cascade or a VAR event, everything, those correlations go to one. Right? The commodity trend strategies, by the very nature of the way they trade, is an uncorrelated strategy. And then you can structure negatively correlated strategies with like tail risk put solutions or long volatility. And so the point of why we always thought about long volatility is like for you to go to an environment from like a risk on environment where like 60/40 is doing great to an environment where like commodity trends doing great, you're usually going to have a violent liquidity event. And so that's what you really need, like tail risk protection for that or long volatility. It's for those really sharp sell-offs when everything's crashing. Correlations go to one. Everybody's throwing out the baby with the bathwater because everybody's going to cash. And we find out who's swimming naked. Those are the times you want that convex cash position. And then you can rebalance and reload back to whether it's 60/40 is going to have a rebound or the commodity trend's really going to take off. So it's really, that's the true crisis alpha in those endogenous liquidity events. And then it usually takes a little bit longer for like a trend following to really take off like it's done for the last 12 months. So it's those different pieces and parts of the portfolio. So what's happened this year is if you're long volatility and the implied volatility or the expectation of volatility is at a certain level, but the market just drips lower and lower every day below that expectations of 30-day forward variance, then you're not going to see a pickup in volatility. So if you're trading long volatility, you're already paying a high price and the market is not jumping past that implied price. And so therefore it's very hard or a headwind to long volatility because it's the price you pay. Like everybody wants to look at VIX, but VIX index is non-tradable. It doesn't really matter at all. It's the price you pay for those options. And so if the price you pay is skewed higher, you need the market to exceed that expectation for you to make money. It's everything in life, right? You need it to exceed the incumbent like expectation. And so that's why a lot of long volatility strategies have had a rough go or a headwind this year, but certain volatility strategies actually have done well. Like dispersion trading has been very well this year. Once again, this is not investment advice and that could change tomorrow, but I'm just saying historically from the beginning of 2022, dispersion trading is doing well. Gamma scalping is doing well because we've had a lot of intraday volatility that's not really showing up to close the volatility. And then the third one that seems to be doing well is much kind of really super long dated, like 7 to 10 year leaps that you can only get in OTC contracts or ISDA contracts across cross asset volatility. So not just equity vol. If you're over in rates vol or FX vol and you have these longer term trades, those have done fairly well this year. So as much as like equity vol has this really high kind of headwind or to it where it's very difficult to really make money in equity vol, if you're using cross asset vol, that tends to do well. But then also if you're kind of really trading that on an intraday basis with gamma scalping, that has done well as well. So that's the difficulty. And then talking about dispersion, just so everybody knows, dispersion is like short index vol, long single name vol. that has done well this year. But dispersion can trade on, like, can turn on a dime on you, and you can get your face ripped off.